The following program is paid for by Lifespan Wealth Management, providing financial advice since 1993. At Lifespan Wealth Management, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, contact their office at 478-922-8100 to set up your complimentary consultation. Lifespan Wealth Management has offices in Macon and Warner Robins for your convenience, and you can learn more about them by visiting their website at retirerelax.com. While you're on the site, visit the special report section, which provides great financial education information on many different topics. You can also sign up to receive their digital feeds, which are short videos providing great information relevant to retirement, investing, and matters that affect your money. They also offer seminars to the community at no cost. If you're looking for a guest speaker for your church or civic organization, give them a call to discuss the topics you would like them to cover. Again, their contact number is 478-922-8100. Now, from the Macon studio of News Talk 940 WMAC, it's time for Your Money with Sherry Goss, Randy Goss, Jonathan Eisner, and Corey Albrecht.
Good morning, Middle Georgia, and it's great to be back with y'all this morning, and thanks for taking time out of your busy schedules to tune in and be with us. So this week, the financial markets rebounded aggressively late this week as geopolitical breakthroughs in the Middle East and a historic tech IPO reversed the early June market slide. Major indexes rallied sharply, triggered by the news of an imminent U.S.-Iran peace agreement that sent crude oil prices and Treasury yields lower, relieving aggressive inflation anxieties ahead of next week's highly anticipated Federal Reserve policy meeting.
Yep, relief on the geopolitical front immediately rebalanced global energy and bond markets. Brent crude futures tumbled 2.9% to about $90 a barrel, while West Texas Intermediate, or WTI, fell to $87.71 after President Trump indicated the U.S. called off scheduled military strikes following a draft peace framework. The benchmark 10-year Treasury yield retreated sharply to 4.45%, down from 4.55 earlier in the week, easing pressures on borrowing costs. Gold rebounded strongly on macro volatility, closing above $4,200 an ounce.
Yep, and all eyes, like I said before, will be on the upcoming Federal Reserve meeting, marking the first policy session chaired by Kevin Warsh. While sticky PPI and CPI data originally fueled fears of rate hikes, the plummeting cost of oil may now allow the Fed to keep the federal funds rate on hold for a little longer.
So Randy and I attended our annual conference last week, so sorry we missed the show. Our primary speaker was the president of a major investment company, and here were his main points from a 1-hour speech, so just hang in there with me. I'm just giving you a summary. He said there is a renaissance in manufacturing. Productivity is up due to AI. Nuclear reactors are the future of power. That technology has not replaced jobs, but is creating new ones in the industrial sector. Chip production is up 175%, which I hadn't seen that anywhere. The U.S. has 43% of the data centers in the world, and that we are in the fourth industrial revolution in history. He talked a bit about Starlink and SpaceX, and that corporate profits are up in small cap growth stocks, and that 31% of the U.S. is wealthy, that a low birth rate is a problem globally, and that they're concerned if inflation starts rising faster than wages, that we're set up for a market correction in September. Due to higher fuel and food prices, and the CPI is higher as transportation is more expensive. So
right.
There's your 1-hour seminar in
60 seconds.
Minute.
Right.
There you go.
Yeah. Well, I can see where they're coming from with this prediction. If the economy relies on spending and costs are high, then that limits spending on discretionary items, and that leads to lower revenues, which could drive a correction. However, spending is not shown to be slowing down at all, like they were discussing. I would say that this aligns with the article that we did last week about the amount of credit card debt that is that the U.S. that has skyrocketed over the past year. And at some point, when the spending stops, that could cause the correction.
Yep.
One of the biggest frustrations with my clients is that cars cost so much. I get it, as I just heard from a client who paid $60,000 for a hybrid SUV, and they love the comfortable ride, and they can afford to buy this car. So I did a little research and found that Toyota is coming out with a hybrid RAV4 this year that gets 40 miles to the gallon, or a plug-in that gets 50 for a starting price of $33,000.
Not bad.
I know that's way better than 60. I also found that a 2026 Hyundai Venue is the cheapest new car in the U.S., starting at $20,550, followed by Chevy Trax, Kia 4, and Nissan Kicks all around $25,000. So Yeah, it's very frustrating shopping for a car right now, and I had clients in just yesterday that their car hit 100,000 miles, and all of a sudden it needs so many repairs that it's not even worth repairing it.
Yep.
I've never
Funny
heard
how
of
that
this.
works.
Yeah, it is.
Oh my gosh, that was terrible. So they're out shopping for a new car because it's not even worth paying to get all of the other fixes done.
Yeah, a lot of cars somewhere between 100, 120,000 miles, they
start failing.
start failing, and they're getting better.
It's
Don't get me wrong.
terrible.
But the timing belts need to be changed, because if those things go, then, or the timing chain, they go, the water pump goes, and
Everything else follows.
Well, wasn't
car
your
falls
truck you
apart.
just traded in about 100,000 miles? Were you even there?
100,000, 98,000
And
miles.
everything started breaking.
Yep.
I don't understand this. I used to drive a Honda.
It's
for like-
frustrating.
the last Honda was I drove it for 250,000 miles.
Right.
I don't get it. Anyways, whatever.
Anyway, let's give you an update on the Trump accounts. The mobile app for the Trump account is now active, which opens up the account activation phase for millions of families ahead of the program's formal launch, ahead of the formal funding launch. These accounts are a great way to start investing for your children or your grandchildren to help them build long-term wealth. You can download the app on the App Store and Google Play. The icon consists of 2 gold bars, like you see in a bar chart, with a gold star. So don't get confused and download somebody's third-party stuff.
Oh, that's a good point. If there's a child born between January 1st of 2025 and December 31st of 2028, the U.S. Treasury will give $1,000 seed money for that child. The account is fully in your child's name, and you are the custodian until they turn 18. You are not required to add anything to the account to receive the $1,000. However, you can deposit up to $5,000 per year to the account to maximize growth. This is a good idea and a really good deal for the kids.
Absolutely.
For sure.
Well, the first thing you need to do is create an IRS account and an ID.me account. Then you need to complete the form 4547, and I encourage you to go to irs.gov/Trump accounts to get started. There's going to be a lot of scammers out there, and we're going to talk about those in just a second, that are going to try to trick you into going to their site. So you'll need to create the ID.me account, and you'll need your child's social security number, the date of birth, and address. It's pretty straightforward. It can be somewhat confusing. Just take your time with it.
Yeah. The ID.me account is a secure digital identity network. We've talked about it before, used by the IRS to verify your identity before granting access to tax records. So you need to create both to get started. To create the IRS account, if you don't already have one, go to irs.gov and click the up arrow next to the sign in on the blue header at the top. Then select Create Account. When you attempt to set up a new account on irs.gov, you'll be automatically routed to the ID.me registration and verification portal. Once the IRS account and ID.me has been established, you'll be ready to fund the accounts this July 4th.
Right.
Which is all of a sudden around the corner.
Just around the
can't
corner,
believe it.
amazingly. Yeah, we are going to build on our weekly scam alert in this segment. As Trump account activation begins, the Treasury Department reminds families to remain vigilant against scams and fraud. The following information will help you know what is real and how to protect yourself during this initial phase. At this time, the initial legitimate communications about the Trump accounts activation will only be sent by email from no-reply at trumpaccounts.treasury.gov. If you get something from anyone else, it's a fraud. In the initial activation email, they state that the future communications will be available in the Trump account app or on the trumpaccounts.com website. So make sure you get the correct app. It's really important. When in doubt, always visit the official app. And like any other IRS or Treasury communications, they will not contact you by text, mail, or a phone call about the Trump account. If you receive a call or a text about the Trump accounts, do not respond. It's likely a scam.
Yeah. Always access your child's Trump account by using the official Trump Accounts app or typing trumpaccounts.gov, like Randy was just saying, directly into the browser. If you do not have access to a mobile device, you can access the Trump Accounts web app through https //trumpaccount.com/. Customer support is available only through secure in-app or online callback requests. Don't use phone numbers found through internet search results. Bottom line, when in doubt, visit trumpaccounts.gov for the latest information.
And if you didn't catch all of this and you have questions, we can email this article to you. So just call us at 478-922-8100 and just tell the people to answer the phone that you want us to email you this piece of this article so that you can keep up with this stuff, because it is bit much. Anyways, more people are choosing to become parents in their 40s and even their 50s. While this decision often comes with greater financial stability and life experience, it also brings some unique financial challenges. And I really can't imagine having a baby at 50. Seriously.
No kidding.
Raising kids later in life can mean facing costs that younger parents might never consider. Understanding these surprising expenses can help older parents plan ahead, reduce stress, and protect their long-term financial health. Whether you're already raising children or considering starting a family at an older age, knowing what to expect is key. Here are 5 surprising costs older parents face when raising kids later in life and how to prepare for them.
All right. One of the most significant challenges for older parents is increased healthcare costs. As we age, medical needs often become more complex and expensive. Raising kids later in life means you may be juggling your own healthcare expenses alongside your children. This can include a higher insurance premium, more frequent doctor visits, and greater likelihood of needing medications or treatments. For example, older mothers may be at higher risk for pregnancy complications, which can lead to costly medical bills. Fathers may face their own health issues while still having young children at home. These overlapping expenses can quickly add up, straining even well-planned budgets. It's important to factor these potential healthcare costs into your financial planning if you're raising kids later in life.
Correct. The next is extended working years or delayed retirement. Many people look forward to retiring in their early to mid-60s. However, raising kids later in life can push this goal further out and possibly out of reach. With children still in school or even college, older parents may find themselves needing to work longer than they originally planned. The costs of childcare, extracurricular activities, and tuition don't disappear just because you're approaching retirement age.
This can create a tough balancing act, so you might need to choose between saving for retirement and covering your kids' needs. I really can't get my head around this whole thing.
That's a tough spot to be in. Some older parents are forced to dip into retirement savings to pay for education or living expenses, which can have long-term consequences. If you're planning to have kids later in life, it's wise to revisit your retirement strategy and consider how these new responsibilities will impact your timeline and financial security.
The next item is paying for college. It's a challenge for many families, but it can be especially daunting for older parents. If you're raising kids later in life, your children may be headed off to college just as you're transitioning to a fixed income. This timing can make it harder to cash flow tuition payments or qualify for parent loans. Older parents may also have fewer working years left to save for college or recover from market downturns. If you plan to help your child pay for higher education, start saving as early as possible, even if it's just small amounts at first. Consider exploring financial aid options, scholarships, and 529 college savings plans, which we contribute to for our granddaughter. Planning ahead is critical to avoid derailing your own retirement while supporting your child's educational goals.
Yep. And the next item that could affect older parents is the sandwich generation pressure. This is where older parents find themselves squeezed between caring for aging relatives and raising their own young children. This sandwich generation pressure can induce unexpected costs, from helping with a parent's medical bills to covering assisted living expenses. When you're raising kids later in life, these dual caregiving duties can be financially and emotionally draining. The demands of supporting 2 generations can lead to difficult choices about how to allocate your time and your money.
It's important to open up conversations with your family about expectations and resources. Planning for these possibilities before they arise can make the challenge of raising kids later in life more manageable.
Yep, and the last item pertains to estate planning and guardianship concerns. Older parents must think carefully about estate planning, especially when their children are still minors. If something happens to them, who will care for the child? Ensuring your wishes are clear and legally binding often means working with professionals to create or update wills, trusts, and guardianship arrangements. These legal services come with their own costs, but they're essential for protecting your child's future.
Mm-hmm. In addition, you may want to consider purchasing life insurance or setting up financial safeguards to provide for your children if you pass away prematurely. The need to go through estate planning is a unique cost of raising kids later in life, but it's one that brings peace of mind to you and your family.
So I totally agree with the life insurance comment, and I just thought of something that we did. So when I started my own business and left my job, which meant that I had a total pay cut until I got off the ground, I bought a 10-year policy, $1 million policy, because you were about 5 years away from retiring from the base.
Right.
And I wanted to make sure that if something happened to you, and here I am starting a business and not making any money with 2 kids in school headed toward college, it terrified me. So we did $1 million 10-year policy, and we didn't have to use it, thank God. but knowing that it was there was a huge relief.
Peace of mind.
So so if you're in any situation where if something happens to you, this could be a disaster for your family, please look into it. Term life policy. Call Jonathan, and he can help guide you through that.
Yep.
Anything else on that?
No, I don't think so.
Okay. Let's shift gears and talk about index funds versus ETFs. We get questions all the time about this, so we thought it would be good to put it in the show. Index funds and ETFs offer a low-cost option for gaining broad market exposure. However, they differ in fees, trading flexibility, and tax structures. Understanding these differences can help investors determine which is more suitable for their portfolio objectives. Indeed, our index mutual funds and ETFs have revolutionized investing over the past few decades, offering low-cost ways for individuals to gain broad market exposure. By taking passive, index-based investment approach, an investor can keep fees low while diversifying their portfolio across industries, sectors, and geographies. This results in the investor approximating universal ownership, that is, owning a representative slice of the entire global economy and positioning themselves to benefit from the broad economic growth regardless of the fortunes of an individual company.
Yep. Index funds are a broad category that includes both passively managed mutual funds and ETFs. The majority of both types of funds are index funds. However, the cost, tax implications, and trading opportunities differ between mutual funds and ETFs. We'll take you through these differences so you understand these important and fundamental portfolio investments. Passive investing through index funds has seen tremendous growth as investors seek low-cost, diversified options to build their portfolios. Index funds track the performance of a specific market index, like the S&P 500 for large U.S. stocks or the S&P 500 bond index for U.S. corporate bonds. The appeal of index funds lies in their simplicity and cost effectiveness. Because there's no original strategy, not much active management is required, so index funds have a lower cost structure than typical mutual funds. These funds have far lower expenses because they mirror an index rather than trying to outperform it. This and their generally good performance have led to their growing popularity.
Both index mutual funds and ETFs are basically a basket full of assets, but ETFs are more akin to equities than mutual funds. Mutual funds are priced once daily after the market closes, and investors buy or sell shares directly from the fund's company. ETFs are listed on the market exchanges like individual stocks. They are highly liquid and can be bought and sold like stock shares throughout the trading day with prices fluctuating constantly. Index mutual funds have revolutionized investing since their introduction in the 70s, offering a low-cost way for investors to gain broad market exposure. These funds aim to replicate the performance of a specific market index, such as the S&P 500 for large U.S. stocks or the S&P 500 bond index for corporate bonds. The mutual funds provide exposure to hundreds or thousands of securities in a single financial product, offering instant diversification.
Yep. Some of the key features are low expenses because they don't have the overhead of a large research team or frequent trading, and generally have lower expense ratios than their actively managed counterparts. These index funds are passively managed and track their target index rather than trying to outperform it, unlike actively managed funds. They are predictable too. They won't outperform their benchmark, but they won't significantly underperform before fees, and that enables you to better predict your returns.
Yep, they're tax efficient because they have a lower turnover, which leads to fewer trades if these funds are held in a taxable account. Index funds are not without risks, however. They'll fall in value when their target index declines, and they may underperform actively managed funds during certain market conditions. Not all indexes are created equal, and some may be more representative of their target market than others. So what about ETFs? ETFs are funds that trade on stock exchanges much like individual stocks. They offer investors a way to buy a basket of securities in a single transaction. ETFs can track various assets, including stocks, bonds, commodities, or even currencies. They can be both actively and passively managed, and they account for a significant percentage of all trading in the U.S. Some of these essential features of ETFs include intraday trading, which means ETFs can be bought and sold throughout the trading day at market prices, unlike mutual funds. Transparency, which means most ETFs disclose their holdings daily. Tax efficiency. ETFs often generate fewer capital gains due to their structure and lower turnover. And lower minimum investments. Investors can often buy as few as one share.
Yep. Here's what you need to know about index ETFs. They were the first type of ETF to begin trading in the early 1990s in the United States. And they track the performance of a specific stock market index, like we've said, and run like an index mutual fund, but with the added benefits of the ETF structure. ETFs have many of the same features as passive management, replicating the index's underlying index with low cost, but they provide that diversification that we mentioned. But one feature that they have that is not found in an index mutual fund is improved liquidity, and that's important because they can be traded throughout the day. The index ETFs were launched in 1993 to track the S&P 500 and the Spider S&P 500, which is the symbol is SPY, and that's the oldest and largest ETF with an annual return of about 9.93 since inception.
Index ETFs tend to be more tax efficient than index mutual funds because of how they're structured. ETFs generally use an in-kind creation and redemption process. This minimizes capital gains distributions that would otherwise trigger tax events. Mutual funds may generate capital gains when the fund manager has to sell holdings to meet redemptions, potentially leading to a tax liability for investors even if they haven't sold their shares. Another distinction lies in investment minimums and transaction costs. Index mutual funds often have a minimum investment requirement, which can be a barrier for some investors. However, these requirements are typically dropped if you are investing through your payroll program.
And you might be curious to know which has a better return. If you're comparing these two types of index tracking funds, you would find their returns are generally very similar when they track the same index because both aim to replicate the performance of that benchmark. Any differences in returns are usually minimal. They often come down to tracking errors, expenses, and how dividends are handled. ETFs might have a slight advantage in that they can be more tax efficient due to their creation and redemption process, potentially leading to fewer capital gains distributions. ETFs and index funds can offer similar levels of safety when they track broad market indexes. The key factor is diversification, which both types of funds provide by holding a basket of securities. This spread of investments helps reduce risk compared with owning individual stocks. But you need to remember that the safety of any investment depends on the specific assets that it holds. A broadly diversified S&P 500 ETF or index fund is generally safer than a narrowly focused sector fund of either type.
That's right. But are index funds better than stocks? Well, index funds and individual stocks serve different purposes and have a distinct different return profiles. Index funds offer instant diversification by holding a basket of stocks, which can help reduce the risk. They also provide a simple way to match market returns without the need for extensive research or stock picking skills. Index funds can be a better choice for many investors, especially those who don't have the time or the expertise to analyze individual companies. Individual stocks can offer higher returns for investors willing to take on more risk and do the thorough research.
The bottom line though, is that these ETFs and mutual funds offer broad, diversified exposure to the stock market and are suitable for long-term investments. ETFs trade like stocks, offering intraday trading flexibility, and they usually have lower fees. This makes them more accessible and tax efficient for retail investors. Index mutual funds provide predictable end-of-day pricing, however, and they may be offered without transaction commissions through certain issuers. And always consider your trading preferences, cost sensitivity, and tax considerations when choosing between these two investment options.
You've been listening to Your Money, brought to you by Lifespan Wealth Management, proudly serving Middle Georgia for over 30 years. Our mission? Helping folks just like you plan for a secure and stress-free retirement. Need a trusted financial advisor? Call us today at 478-922-8100 and schedule your complimentary consultation at our Macon or Warner Robins office. Want to learn more? Visit us anytime at retirerelax.com. Because when you plan smart, you can retire and relax. And here's something extra. We offer free educational seminars for the community. If your group needs a guest speaker, give us a call and let's make it happen. That's 478-922-8100. Now, let's get back to the show.
All righty, let's discuss health savings accounts, another really exciting article. Recently, I had a call from a client who had met with an insurance broker who informed her that she could transfer money from her HSA into her IRA. Unfortunately, that is not true. The IRS treats health savings accounts strictly as a medical savings tool, meaning that HSA funds can only be rolled into another HSA. While you can't roll your HSA directly into your IRA, you could reimburse yourself for expenses you've previously paid in the past, which is a big change because I remember when I had an HSA, it had to be done the year of that I could the year that I had whatever doctor appointment or whatever thing I had to be done that year. So this must have been changed. But anyways, that's that you've previously paid in the past and retain your receipts as proof. Then once the funds are in your bank, you can use the funds any way you want because it was a reimbursement for legitimate medical expenses.
Yep. There is an article titled "A Healthcare Play Immune to Trump's Tariffs," and it's crushing the market, and that's in quotes. Is circulating the web, and the author lists the benefits of HSAs like tax-free contributions, tax-free interest and investment earnings, and the tax-free distributions for qualified medical expenses. And these are true statements. However, he goes on to say that that you can even roll your HSA into your IRA or other qualified retirement accounts when you're ready for Medicare. Like Sherry was saying, this statement is just not true, and there's no provision for rolling health savings account balances into a retirement account. And it's a good thing because health savings accounts offer more tax benefits than any other of the retirement accounts. And HSAs can be used at any time tax-free to pay for qualified medical expenses, things like health care insurance, plan deductibles, holistic care, etc., which is not true of an IRA.
Yep. If you withdraw funds from your HSA to use for any other purposes before age 65, you'll pay taxes on the distribution as well as a penalty. After age 65, you won't. So that at that point, the HSAs work just like any other retirement account, including IRAs. But you can fund an HSA from your IRA. You can transfer money from your IRA to a health savings account tax-free using a qualified HSA funding distribution, which is a QHFD, authorized under Internal Revenue Code Section 408D9. You're able to do this just once in your lifetime. You're able to do this because it is a direct trustee-to-trustee transfer that counts toward your annual HSA contribution limit.
Yeah, but there are some key rules and requirements that you do need to be aware of. First thing you need is a high deductible health plan at the time of the transfer. And next, there is a testing period, meaning you must remain enrolled in the high deductible health plan for a continuous 12 months period starting on the date of the transfer. If you fail to meet this requirement, the transferred amount will not be counted as taxable income, will be counted as taxable income and be subject to the additional 10% tax penalty. And lastly, since the funds are already in a tax-advantaged account, the transfer does not qualify as a tax-deductible HSA contribution.
So if you have an HSA, the opportunity at a business, a company where you work for, please take advantage of it because it could save you a lot of money.
It's a good deal.
For sure.
All righty. Next up, young voters embrace socialism. Aren't you excited about that?
Nope.
Far-left politicians want to annihilate property rights. A large share of young voters are buying into it, a red flag that our school system has become a socialist indoctrination factory. On Monday, one of the far-left agenda setters, Senator Bernie Sanders, called on the federal government to confiscate half the value of each of the nation's largest artificial intelligence companies through a levy of 50%, a ownership tax, he's calling it. He's targeting OpenAI, Anthropic, which is the creator of Claude, and xAI for starters. Making his announcement on Facebook and in the New York Times opinion piece, Sanders said he'll introduce a bill in Congress to slap these companies with a 50% ownership tax, which is a shocking defiance of the U.S. Constitution.
Yeah, that's crazy. Sanders' flimsy argument is that since AI is built on the collective knowledge of humanity, the wealth it generates must benefit humanity. It's straight out of the playbook of Lenin, Castro, or any other communist dictator.
Right. If that's his reasoning, why don't we take 50% of everything ever invented, as we've spent thousands of years on this planet collectively adding to our knowledge base? If that were not the case, we would still be living in caves and cooking our dinner over a fire. Who would
sounds
invest?
kind of relaxing.
Yeah,
It does.
some days. Who would invest or invent if the government would swoop in and take half? Sanders' bill is going nowhere while the Republican majority is in Congress, at least. But ignored it at your peril. It's a warning. Confiscating property is a left's latest talking point to remedy inequality and pay for the ever-expanding public benefits.
Sanders borrowed the idea from his lawyer friends at George Washington University School of Law and University of California at Davis School of Law. The Constitution's Takings Clause, Bill of Rights Amendment 5, bars the government from taking property without providing just compensation. It's bad enough that the term fight against blight is allowing the use of eminent domain to be used to confiscate property for commercial use across America.
Right. New York City Mayor Mandami agrees. He warned at his inauguration that he was going to introduce New Yorkers to the warmth of collectivism. warmth of collectivism. That's not an easy thing to say.
No, it's not.
His new block-by-block housing plan proposes transferring building ownership from current owners to what he calls responsible stewards. This includes handing buildings over to tenants, another outrageous attack on property rights.
Pay attention to how fast Democratic Socialists of America, or DSA, candidates spouting collectivism are making headway. Last week's primaries produced outright wins or runoff advancements for more than a dozen candidates in 5 states backed by the DSA. Who likes these ideas? A lot of Gen Z voters that have a rose-colored view of socialism, communism, and collectivism. According to a Heartland Institute/Rasmussen poll, at the end of 2025, nearly 60% of likely voters aged 18 to 24 want a Democratic Socialist in the White House in 2028. Mandani captured 78% of under 30 voters in November, according to an ABC exit poll.
The DSA, at one time the haven of radical retirees, is now powered by the young. It saw the average age of its membership plunge from 68 to 33 in less than a decade. The leftist indoctrination in K through 12 schools as well as universities is largely to blame for the youth vote's enthusiasm for socialism and communism. A staggering 62% of voters aged 18 to 29 hold a favorable view of socialism, and 34% favor communism.
Wow. That's what they're taught in school, though. Cool Kid Facts, which is a popular education website, teaches students that communists believe the state should provide every citizen with their basic needs, and no one is above anyone else. Sounds very utopian. No mention of the brutalities, starvation, and mass murders committed in the name of communism by Lenin, Stalin, Pol Pot, or others. In New York State, social study classes. In New York State social study classes, communism and socialism are presented as two economic systems that make things more equal and fair, with no historical references to the atrocities committed by the socialist or the communist regimes in confiscating property. Not to mention the vast amounts of funding China and Russia are pumping into the websites in the U.S. to help indoctrinate our citizens.
Yeah. Governor Ron DeSantis signed a new law last year requiring the public school students in Florida be taught the brutal realities of life under communism. Texas passed a similar law. That's one way to counter the heavy-handed indoctrination by the teachers' unions. Let's make sure students also learn about the Takings Clause and why protecting property rights is essential to economic growth. Confiscating capital is the fastest way to kill an economy. Sanders' AI confiscation scheme is just the beginning. Confiscation scheme is just the beginning. Allow that industry to be nationalized, and the left will soon target others, destroying our economy and our personal liberty. The best defense, the only defense, is an educated electorate. Considering the misguided attitudes of many Gen Z voters, it appears there is no time to waste.
So, why is this a good article for this show, Your Money? Because socialist and communist ideas undermine American freedoms and enterprise by replacing free markets with government control, which stifles innovation, eliminates the profit incentives required to start and grow businesses, and forces citizens to rely on the state for their livelihood rather than individual merit.
It will eradicate private property ownership. The stock market functions by allowing individuals and institutions to own a stake in private, profit-seeking companies. Communism in its truest form, calls for the abolition of private property and the public state ownership of the means of production, which would render public equity markets obsolete.
You know, the stock markets exist to allocate capital to the most productive and promising businesses, fostering growth and creating jobs. Centralizing all capital into the hands of the state eliminates this dynamic investment environment. Replacing it with bureaucratic quotas, basically, it could cause the loss of capital formation.
So just to talk about this, I find this extremely disturbing.
Same.
And all of you listeners out there are probably around our age, I'm betting. I mean, you're probably around your 60s or so. I've met some young people that do listen to the show, but I think mostly it's people that are probably retired or that just really like AM 940, which a lot of young kids don't listen to.
A lot of young kids don't even know that an AM
channel
radio
exists.
channel
That's
even
true.
exists.
So next time you have your grandkids, it'd be really good to talk to them about some of these concepts and if they've heard about them or been taught them and what they think about it, or do they even know about it?
Yeah.
It's terrifying to me to see that percentage of kids being doctrinated into this mindset because this could be bad.
It can be.
For sure.
So anyways, it's a big concern. So that's why we're talking about it. But yeah, talk to your kids and your grands about it because hopefully they don't they buy into this.
Yeah. The statistics say that they do, which we got to change course on that.
It's a sad thing.
How to change your future one raise at a time. We're going to talk about a hypothetical couple who started out like most couples. With regard to their money, they felt like they were doing everything right. Both had steady jobs, they were paying their bills on time, and they worked hard every week. Yet, despite their efforts, money always seemed tight. By the end of each month, there was little left in their checking account, and unexpected expenses often ended up on a credit card. Sound familiar? Like many young families, they believed their financial situation would improve once they earned more money. They looked forward to promotions, raises, and better opportunities, assuming that a higher income would solve their problems. For a while, it seemed like it did solve their problems, because upgrading your life with a pay raise feels good. However, with the new pay raises, they upgraded to a newer vehicle with a larger payment. They began eating out more frequently and took a vacation they had been postponing. Life felt more comfortable. Despite earning more than they ever had, they still felt as though they were living paycheck to paycheck. The numbers on their paychecks had increased, but so had their expenses. The financial stress they thought would disappear had simply followed them into a higher income bracket.
One day they had an epiphany after reviewing their finances, an epiphany that would change their lives. Their problem wasn't that they weren't earning enough. The problem was that every dollar of additional income immediately became additional spending. That night, they committed to do things differently going forward. Instead of spending every future raise, they created a simple rule. Whenever either of them received a raise, half of the increase would automatically go towards savings and investments. The other half would be used to improve their lifestyle. It's a rule that felt fair. They would still enjoy some benefits from their hard work, but they would also make sure their future improved along with the lifestyle improvements.
The first year, the change barely seemed noticeable. They built a small emergency fund and paid off one credit card. It wasn't anything dramatic. No one outside the family would have even noticed a difference. The second year, another raise arrived. They followed the same rule. Half went into savings. Half went into their household budget. Gradually, they began to see progress. Their emergency fund grew large enough to cover several months of expenses. When the washing machine died, they paid cash instead of reaching for a new credit card. When one of the cars needed repairs, it was an inconvenience rather than a financial crisis. The confidence that came from having money set aside was something that they had never experienced before. As years passed, they made additional changes. Instead of replacing vehicles every few years, they drove them longer, like Sherry's Honda. Instead of financing furniture, they saved and paid cash. Rather than buying things simply because they could afford the monthly payment, they asked whether the purchase would truly improve their lives.
Yeah. The decision on spending turned out not to be a life of sacrifice. In fact, they still took vacations, enjoyed hobbies, and spent money on experiences that mattered to them. The difference was that spending became intentional. When their friends received raises, many immediately upgraded their lifestyles. Larger homes, newer vehicles, and more expensive vacations and additional monthly payments became common. They occasionally felt tempted to do the same thing, but they stayed committed to their plan. Every raise increased their savings rate. Every year, their investments grew. Over time, something remarkable began to happen. The money they had invested started earning money on its own, which is where we all want to get to. Yes, at first it was small. Then it accelerated. What had started as a few $1,000s eventually became tens of thousands of dollars, and then later became hundreds of thousands of dollars. By their mid-40s, they had paid off all of their consumer debt. By their early 50s, their mortgage balance had shrunk dramatically. They found themselves in a position that they had never imagined possible when they were newly married. For the first time, work became a choice rather than a necessity. People often assume that there had been a lucky break somewhere along the way. They believed that they must have inherited some money. Others assumed that they made risky investments that paid off. The truth was far less exciting.
There was no lottery ticket, no inheritance, no secret investment strategy. Instead, there were hundreds of small decisions made consistently over decades. They saved part of every raise. They avoided unnecessary debt. They spent thoughtfully rather than impulsively. Most importantly, they allowed time to work in their favor. Looking back, the most important lesson was learning to separate income from lifestyle. Many people believe that earning more automatically leads to wealth. In reality, wealth is often built by increasing saving faster than spending.
True. Their story illustrates an important truth about moving up financially. Most families do not experience a dramatic overnight transformation. Financial progress usually happens slowly and quietly. It is built through habits repeated month after month and year after year. The family's journey from financial stress to financial security did not happen because they earned extraordinary incomes. It happened because they made intentional decisions with the money that they did earn. In a world that constantly encourages people to spend more, their greatest financial advantage was learning what not to do. And in the end, that simple decision to save part of every raise instead of spending all of it changed the trajectory of their lives and created opportunities for the next generation of their family as well.
So this is a good story, and it's not a fairy tale. If you're struggling with debt and don't feel like you are making any progress financially despite the increased income, take a step back and really examine how you spend your money and save money. Simple changes that you consistently employ in your income and spending regime can and will make a tremendous impact. And the biggest thing I would tell people to do is to track every penny you spend for a solid month. Get a piece of paper, make categories, and every day at the end of the day, write down what you spent. Did you eat out? Did you put gas in your car? Did you pay a bill? Where's your money going? And then evaluate at the end of the month where it's going and what you need to change.
Yep.
And that will really help you get kicked off into this process.
Yep. All right, very good. Let's talk about the artificial intelligence initial public offering wave that is arriving, and the offerings coming out to the market are unlike any in recent memory. SpaceX launched its IPO yesterday. OpenAI is expected to conduct their IPO somewhere between September and November of this year. And Anthropic has just closed a $65 billion Series H of funding for $965 billion, which sets it up for an IPO offering sometimes late summer or early fall. Combined, these three offerings could demand north of $200 billion from the public markets, and that is huge considering the entire U.S. IPO market raised just $45 billion in all of 2025. So, with all of this in the news, let's talk a little about what an IPO is and how they work by starting with two foundational concepts. The first, an IPO is simply a financing event for the company going public. It is a great way for them to raise capital needed to fund future growth. Second, it is a liquidity event for early investors and company insiders, giving those who back the company in its earliest stages an opportunity to convert their shares into cash.
Retail investors often get excited about new offerings because they misunderstand these two goals and who the process is designed to serve. That does not mean IPOs cannot be excellent investments for retail investors, because some of the greatest wealth creation events in modern history have come through public offerings. But the process, the valuations, and the historical record all suggest that enthusiasm is not a substitute for a clear framework. So today we're going to talk through how the IPO process works and who is involved. We will also provide a little guidance on how investors may want to evaluate these specific offerings. Then to wrap things up, we will take a look at how today's AI IPOs compare structurally to the 90s tech wave and what the long-run historical evidence on IPO performance tells us about the road ahead. Let's start with the IPO process. When a company decides to go public, it hires investment banks to underwrite the IPO. These banks conduct a roadshow, which is a series of presentations where a company's executive team and its underwriters pitch the business to prospective institutional investors. Basically, these presentations are designed to generate excitement, assess market demand, and collect feedback to help finalize the stock's offering price.
These institutional investors can access shares of the designated IPO price, while retail investors rarely have that same access. Retail investors typically buy after trading begins, often paying more and sometimes a lot more per share than insiders and institutions. There are two structural dynamics that influence price behavior in the months that follow. The first is the lockup expiry. After an IPO, lockup agreements typically prevent company insiders from selling their shares for somewhere between 90 and 180 days. When that window opens, a significant amount of new supply can hit the market all at one time, driven less by the company's business performance and more by liquidity demand.
That's right. And this can create meaningful downward price pressure regardless of how the underlying business is performing. You can often see this in the downward pressure in the charts, with the cup shape forming as the stock dips and then starts back up in a few months or a few weeks. This is often a buying opportunity as well.
Yeah. The second item is the index inclusion process. As newly listed companies join major indices like the S&P 500 and Russell 1000, passive funds must purchase shares regardless of price or valuation. The size of these IPOs will render this formerly obscure process a major focus for market participants in the months ahead.
If you're considering buying an IPO, once it is available to the public, you should download and review the prospectus to understand what you are buying into. The The prospectus contains a breakdown of who is selling, how proceeds will be used, and the full financial picture of the company. The prospectus will help you separate the signal from the noise.
Yeah, I downloaded SpaceX's prospectus yesterday. It was 363 pages.
So you've read the whole thing
of light reading.
Oh my gosh. There are a couple of key things you want to determine when reviewing the prospectus is what is the motive? Why is this company deciding to go public now? A specific need for capital, like accelerating a product or building infrastructure, is a more credible answer than the market is hot. In this case, the companies coming to market do have genuine and substantial capital requirements. The timing is not coincidental. Demand for private tech shares have been voracious, and institutional and retail investors alike have spent years accessing AI via proxy by buying NVIDIA for chip exposure, which we do have in the portfolio, Microsoft for its OpenAI stake, which we also hold, and Alphabet for its DeepMind and Anthropic positions. The companies going public now and their bankers know that pent-up demand exists and are pricing accordingly.
Yep. You also want to know who is selling the shares. A primary offering in which the company sells new shares to raise capital for the business is a more credible structure. It means founders and early investors are not exiting, and the proceeds are going back into the company. An offering with a heavy secondary component is where the existing shareholders sell their shares. In this case, it would be a signal that the people who know the business best are reducing their exposure. For example, SpaceX's offering appears to be structured primarily to raise capital, which is the right approach for a company with genuine capital needs. A harder thing to understand is, does the valuation make sense? IPOs are priced on demand, not intrinsic value. Demand value is what people are willing to pay for it based on the desire, the scarcity, and the market trends.
Whereas intrinsic value is the objective, fundamental worth of an item based on its underlying utility, cost of production, or generated cash flow. SpaceX, for example, is filing at $1.75 to $2 trillion total valuation against 2025 revenue of approximately $16 billion and a $4.9 billion net loss. OpenAI attracted an $852 billion valuation in its last private round against a $20 billion annualized revenue. Anthropic reported a $47 billion revenue run rate and expects its first operating profit this year. These are very different businesses with very different financial profiles at broadly similar and high valuations. All these companies are part of the new industrial revolution that Sherry mentioned at the beginning of the show. And there are a lot of new companies coming online.
Yes, there are. So how does a wave of IPOs compare to past offerings? In the 1990s, public markets were the primary source of growth capital. Amazon went public in 1997 with a valuation of $438 million, with less than $16 million in annual revenue, just 3 years after its founding. Netscape was barely a year old at its IPO, valued around $2 billion on the first day of trading. Google went public at $23 billion in 2004. Facebook, then the largest tech IPO on record, debuted at $104 billion in 2012 when it was just 8 years old.
In contrast, in the 1990s, hundreds of companies entered the public markets each year, giving investors a broad set of opportunities. Today's IPO wave revolves around a handful of companies that are going public later, larger, and at a higher valuation than their 90s counterparts.
The difference isn't that these are better businesses. Over the past 2 decades, private capital markets have expanded dramatically, providing growth funding that once came primarily from public investors. Venture capital, private equity, and sovereign wealth funds now deploy hundreds of billions of dollars, allowing companies to reach enormous scale before they go public.
Right. And by the time firms like SpaceX or OpenAI eventually list, much of their most explosive growth may already have accrued to private investors. But that is not necessarily a problem. Amazon, Google, and Facebook generated substantial gains both before and after their IPOs, creating enormous value for public shareholders.
That's right. The key difference today is the starting point. Public investors are often entering later and much higher valuations, making disciplined analysis far more important than ever. For example, Anthropic's estimated price-to-sales multiple of around 21 is comparable to Facebook's IPO in 2012 and considerably more grounded than SpaceX's at 110 times or OpenAI at 43 times earnings. These are not the same investment propositions, and they should not be evaluated as such.
Let's take a look at historical IPO performance and volatility. The historical record on IPO performance reinforces the need for caution. The valuation at entry and timing can be as important as company quality. An interesting fact is that the average IPO underperforms the broader market over a 3 to 5 year time horizon. Jay Ritter of the University of Florida has tracked IPO performances since 1991. His data shows the initial run-up accrues almost entirely to institutional holders. The 2020 to 2021 IPOs illustrates this clearly. Retail investors, flush with COVID-era stimulus, bid them up. After this initial demand, sustained underperformance followed as rates rose and growth multiples compressed. We are currently in a similar hot macro environment with risks of higher rates.
The biggest risk is not that these companies fail to create value over the long run, but investors need to understand that the journey to that value can be long, volatile, and unforgiving, especially for investors who buy at the wrong price or sell at the wrong time. For example, investors who bought Amazon at its IPO in 1997 and held their shares through the dot-com collapse and the company's eventual recovery earned significant rewards a decade later. However, the path was not linear, and timing mattered at every point along the way.
Yeah. Investors who bought Amazon near their peak in 1999 watched their gains just evaporate, falling more than 90% from the high and then facing years of losses before the stock ever recovered.
Right. And investors who bought Amazon during the IPO rode the wave to the peak and sold on the way down, locked in losses on a company that went on to become one of the greatest wealth creators in the market history. The experience of investors who bought at the wrong moment or sold at the wrong moment was a different story entirely.
The lesson is not to avoid these companies. It is to understand that volatility creates a specific and underappreciated risk of a strong initial run-up, the eventual evaporation of early gains, and the behavioral pressure to sell at precisely the wrong moment. Patience and entry point matter as much as conviction in the underlying business. There are a few key takeaways from this discussion. The AI IPO wave of 2026 will test investors' discipline in a nearly unprecedented way, and that investors most likely to generate strong risk-adjusted returns may not be those who buy day one out of excitement, but those who do the research and critically evaluate the opportunity ahead.
That's right. Here are a few important things to remember about IPOs. Well, the IPO is designed to serve the company and its early backers first, the institutional investor. Retail investors almost always buy at higher prices than the institutional allocators, and a structural dynamic around lockups and index inclusions can create additional price volatility in the months that follow. Next is the primary and secondary split is a valuable signal. A company that is raising capital for its own use is more credible than primarily serving insider liquidity. You need to read the perspective.
Yep. You've read the 363-page prospectus twice by now.
Yeah, I have. Yeah, it's playing in the back of my head
that you
now.
printed yesterday.
Oh, I didn't print it.
Oh,
I saved it as a PDF.
Good point. Today's wave of IPOs is structurally different from prior ones because investors are entering it at a later stage and a much higher starting valuation than prior technology waves. That does not eliminate the opportunity, but it does require a different analytical approach to evaluate it accurately.
History does not necessarily repeat itself. The 1990s tech IPOs created enormous long-term wealth, but investors who bought at peak valuations or bought and sold at the wrong time often waited a decade to recover. The companies were transformative. The entry point and valuation still mattered.
Yep. And it's too early to say with confidence which of these AI IPOs will reward public investors and which will test their patience. So be careful before you just jump in because the market seems, like everybody's doing it. You don't want to have that fear of missing out. So just be careful. Next week we have a great article we're going to talk about. It's about how your data that gets sold, between all these different vendors that you use is used to set the prices when you're shopping online. But what else you got here, guys?
I would say the amount of tracking that's being done on you when you're online in general is very scary.
It is scary.
And sometimes, I don't know if I'm in this school of thought necessarily, but sometimes people feel like they have a thought that doesn't ever even exit their mouth.
Yes.
And then they get on their phone or their computer, and what they were thinking is
right there, isn't
being
it?
sold to them right there in an advertisement.
That's right. It is weird.
It is very weird.
And you go to a different computer, and you sit down, and as soon as you log in, everything pops up there. It's like black magic.
They're following us. They're following us.
Anyway, we're closing in on the end of the show, and we do greatly appreciate everybody for sending in questions to us that you want us to investigate that we can talk about on the radio show. So keep those coming, and you send those to Randy at rfmoney.com. And I think that's about it. So we will talk to y'all next year.
Have a
next
great
week.
weekend.
Next year.
Next
Thanks
year.
for listening to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, please contact their office at 478-922-8100 to set up your complimentary consultation. You can learn more about them by visiting their website, retirerelax.com. And if you have a question or a topic that you would like them to cover in next week's broadcast, you can email Randy at rfmoney.com. They look forward to connecting with you next week. Have a great weekend, everyone. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.